Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial news that actually matters. Today we are looking at Allegro MicroSystems and a report that hints at some significant financial moves. Before we dive in, if you like getting clear explanations of complex financial documents, make sure you hit that subscribe button. And if you want to chat about these findings with other finance enthusiasts, join our Discord community linked in the description below. Alright, so Allegro MicroSystems, an important player in the semiconductor industry, has filed a current report on Form 8. Now, 8Ks are filed when a company has something significant and newsworthy to announce that isn't part of their regular financial reporting cycle. Think of it as a company being required to shout out important updates. The big news here isn't about their ongoing business performance in terms of sales or profits for a specific quarter, but rather a major behind-the-scenes financial maneuver. The filing's main purpose is to talk about a refinancing and repricing of their debt. Essentially, they are looking to change the terms of money they owe, aiming to get better interest rates and potentially more favorable repayment schedules. This is a common practice for companies to manage their finances more efficiently and reduce their borrowing costs. Allegro has been working on a new US dollar denominated first lien term facility. This means they're getting a new loan, and it is in US dollars. It is secured by their assets, making it a first lien loan, which means the lenders get paid back first if anything goes wrong. This particular facility is a substantial $285 million and is set to mature in October of 2030. This tells us they are planning for the long term with this new debt. Now, let's talk about the juicy part, the money. They expect the interest rates on this new loan to be quite attractive. For loans tied to the secured overnight financing rate, which is a common benchmark, the margin will be 1.75%. For loans that use a base rate, it is even lower at 0.75%. These rates are important because they directly impact how much money Allegro has to pay out in interest expenses. Lower interest costs mean more money for the company to invest in its growth, research and development, or to return to shareholders. The key takeaway here is that Allegro plans to use the money from this new loan to pay off their old loans completely. This isn't just about getting a new loan, it is about replacing existing debt with better terms. Companies do this when interest rates have dropped or when their own financial health has improved, allowing them to negotiate better deals with lenders. It is a sign that they're proactively managing their financial structure. It is important to note that this filing is in progress. The company states that the final terms will be disclosed once the deal is officially completed. They also mention that the transaction is subject to the usual conditions and is expected to close in January 2026. However, they wisely include a disclaimer saying there is no guarantee that the deal will go through as planned, or at all. This is standard practice to manage expectations and avoid legal issues if the deal falls apart. Allegro MicroSystems common stock trades on the Nasdaq stock market LLC under the ticker symbol ALGM. This is how the company's shares are listed and traded by investors. Knowing this helps us understand where the company fits into the broader stock market and its accessibility to public investors. This section, Regulation FD Disclosure, is essentially about ensuring fair disclosure of information to all investors. It means that when the company makes material non-public information available, they do it in a way that is accessible to everyone, not just a select few. The information about the refinancing being shared in this public filing adheres to that principle. Now, this is a crucial part of almost every corporate filing. The company includes a section on forward-looking statements. This is a legal disclaimer that essentially says all statements about future expectations, plans, or goals are just that, expectations. They are not guarantees. These statements are based on current beliefs and assumptions, which might not turn out to be true. This part is filled with legal language about risks and uncertainties that could affect their actual results. It is there to protect the company from lawsuits if things do not go as they predicted. For us as investors and analysts, it serves as a reminder to approach any forward-looking statements with caution and to look at the underlying financials and historical performance for a more realistic picture. This section lists the exhibits that are part of this filing. It is like an appendix or supporting documents. In this case, it is mostly technical files related to how the report is formatted for electronic filing, like the cover page interactive data file. There are no actual financial statements in this specific filing. Which makes sense because this report is about a future event, a debt refinancing, not a summary of past financial performance. So, what does all this mean for Allegro MicroSystems? From a corporate finance perspective, this move to refinance and reprice their debt is generally a positive sign. It suggests that the company is in a stable enough position to command better lending terms. Lower interest expenses will free up cash flow, which can be used for strategic initiatives, debt reduction, or even potentially stock buybacks or dividends in the future, depending on their overall financial strategy. It shows a proactive management team focused on optimizing the company's capital structure. The fact that they are planning this substantial refinancing indicates confidence in their future revenue streams and ability to service their debt obligations. However, it's essential to remember the cautionary notes. The transaction is not guaranteed. External economic factors or internal company performance could still disrupt the deal. Investors should keep an eye on the follow-up filings that will confirm the completion of this refinancing and provide the exact final terms. While this is a good financial housekeeping move, it doesn't automatically translate to increased sales or product innovation. That will depend on their core business operations, which are not detailed in this particular filing. The risks mentioned in their forward-looking statements related to market conditions, competition, and technological changes in the semiconductor industry still apply and represent the more significant factors to monitor for long-term success. In conclusion, Allegro MicroSystems is making a smart financial move by refinancing its debt, aiming for lower interest costs and a more manageable repayment structure. It's a sign of financial prudence and a step towards strengthening their balance sheet. While we need to wait for official confirmation, this is a generally positive development for the company's financial health. Alright, that's our deep dive into Allegro Systems' latest filing. What do you think about their debt refinancing plans? Do you see this as a solid move for the company? Let us know your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up and don't forget to subscribe for more corporate insights. And remember to join our Discord community for more discussions. Thanks for watching and we'll see you in the next video.